China's bold moves in 2025 to 2025 is shaping up to be a pivotal year, with massive shifts on the horizon. On this channel, we often dive into the U.S. economy because its decisions ripple across the globe. Whether it's printing money, raising interest rates, or funding a war, the consequences are global. There's no escaping the impact of U.S. actions, and with Trump making a return soon, we should prepare for significant developments like mass deportations, tariff wars, and the weaponization of the dollar. But today we'll focus on China. The world's second-largest economy is increasingly distancing itself from the West, a trend that became clear in 2024 and is only growing stronger now. In his New Year speech, President Xi Jinping reaffirmed China's commitment to hitting a 5% GDP growth target for 2024. But the road ahead in 2025 will be far more challenging. Maintaining these numbers will demand drastic measures. To put it bluntly, China's economy is facing serious headwinds. The real estate crisis has wiped out significant wealth, dampening consumer spending. The G7 nations are increasingly closing their markets, with trade barriers on electric vehicles, EVs, and solar panels adding to the pressure. These challenges are not coincidental. They mark a growing divide between China and the West. The only way for China to weather this storm is through self-reliance. And with Russia on its side, it might just have the resources to pull it off. But there's one critical issue China must tackle: inflation. The IMF forecasts that inflation in China will climb to 2% by 2026. However, recent data shows that China's GDP deflator is currently negative, down by 1%. Essentially, the country's overall growth is being dragged down by deflation, which creates a tough situation for Beijing, especially as it seeks to achieve 4 to 5% growth in 2025. To reverse this trend, China will likely have to launch massive stimulus measures, and it's already taking action. For instance, the government has raised salaries for civil servants to encourage spending. While the raise might seem modest, around 500 yuan a month, or about $70 US, it's still a meaningful 4 to 5% increase for those who earn less than $1,500 per month on average. Public spending plays a crucial role in China's economy, much like it does in the G7 countries. By increasing salaries, Beijing is attempting to address the deflation and the housing crisis. If it can't stabilize home prices, it might try to boost consumption by pushing up wages. In this way, China's approach is similar to the West's economic stimulus programs, but with its own unique twist. Turning to global dynamics, China is preparing to decouple from the West while simultaneously globalizing its influence. While the West, especially the U.S., has been vocal in its trade wars, China is adopting a more strategic, subtle approach. If you read between the lines of President Xi's New Year speech, you'll notice a clear shift in priorities for 2025 and beyond. For example, Xi highlighted that China's grain production is now surpassing 700 million tons, with a focus on domestic food supplies rather than imports. The emphasis on homegrown food is a significant shift, indicating that China is moving away from reliance on foreign imports. This strategy will have a direct impact on U.S. agriculture, particularly American farmers already grappling with razor-thin margins. American farmers are already facing significant challenges, and the situation may worsen if the U.S. continues to rely on immigrant labor. In 2021, over 1.6 million undocumented immigrants were working in the U.S. food supply chain, including farming, food production, and wholesale sectors. This number has likely increased significantly. If a large portion of this labor force is deported, farm profits in the U.S. could plummet. Combine that with the growing trade war with China, and you have a recipe for disaster in the agricultural sector. Take the 2018 tariff war as an example. When China retaliated, U.S. soybean exports dropped from $12 billion to under $3 billion, a staggering 70% decrease. If demand falls again while costs rise, the consequences for American farmers could be dire. The storm clouds are gathering. We haven't yet felt the full force of the changes coming in 2025, but the warning signs are unmistakable. If China's policies continue to shift, the global economic landscape could change dramatically, with profound effects on both the U.S. and China. Only time will tell how these strategies unfold, but for now, the game is changing, and we all need to be watching closely. Global shifts. The EV battle intensifies. As we move into the next phase of global trade, it's important to observe key projections that show China's growing focus on domestic production. When we analyze the data, particularly around agriculture, one major shift stands out. China is significantly increasing its soybean production. From 23 million tons in 2022, the country aims to scale this up to nearly 40 million tons within 8 years, an astonishing 80% increase. Imports, however, will shrink from 92 million tons to 82 million tons. While China will still need to import substantial amounts of food, it begs the question, where will it come from? Will China lean on traditional suppliers like the U.S., or will new economic partners, such as Brazil, play a bigger role? This shift suggests that the future of food production is becoming more localized, with major trade benefits likely going to the BRICS nations, especially in the midst of trade tensions. One of the clearest indicators of this transformation is China's continued investment in its critical industries. For the first time, China has exceeded the production of 10 million new energy vehicles, EVs, in a single year, a huge milestone. In addition, the country is making significant strides in fields like integrated circuits, artificial intelligence, and quantum communication. Let's delve deeper into the EV sector. China's EV production is reaching global markets with unprecedented speed, and this surge is shaking the automotive industry. To survive, Japanese manufacturers like Honda and Nissan are considering merging, a move that would have seemed impossible just 5 years ago. Meanwhile, BYD has delivered a record-breaking 4.2 million EVs and plug-in hybrids in 2024 alone. With China's unbeatable combination of advanced technology and aggressive pricing strategies, the competition is feeling the pressure. Despite tariffs imposed by the EU and the US blocking BYD from entering its market, sales are soaring. Remarkably, BYD is now approaching the same sales numbers as Ford or Honda, despite having completely phased out internal combustion engines since 2022. Looking at the competition between BYD and Tesla, it's clear that the market is rapidly shifting. Tesla, the world's most valuable automaker with a market cap of over $1 trillion, has historically led the pack. But in the fourth quarter of 2024, BYD actually surpassed Tesla, delivering 880,000 more EVs. The driving force behind this surge? Local demand. The Chinese government has poured massive subsidies into local consumers, creating a huge domestic market for EVs. This means that even if the trade war escalates in 2025, China's domestic companies won't be as vulnerable as some might think. The government could easily boost stimulus programs to keep local sales high. However, this also means that China will likely continue to limit the sharing of its EV technology with Western companies, reserving it for BRICS partners and other close allies. Speaking of BRICS, the global dynamics of trade and production are shifting. The BRICS alliance, originally composed of Brazil, Russia, India, China, and South Africa, has grown significantly. New members like Indonesia, Malaysia, and Thailand, heavyweights in Southeast Asia, are joining the bloc. These countries are fast becoming critical hubs for manufacturing outside of the West, with competitive production costs that allow them to meet both production and demand needs. This gives BRICS an upper hand in sanctions-proofing their economies, particularly in the event of a global trade war. Should the U.S. escalate tensions with BRICS countries, the bloc will not crumble overnight. In fact, the BRICS nations are increasingly bypassing the dollar in favor of local currencies for bilateral trade. In the first 3 quarters of 2024, China's foreign trade with BRICS countries hit nearly $650 billion, a 5.1% year-on-year increase. This trend has profound implications for global trade, as more transactions move away from the U.S. dollar. This shift threatens the dominance of the dollar, which is critical for U.S. economic power. In response, the U.S. might attempt to bolster its influence by increasing investment in BRICS countries, perhaps by opening factories in places like Brazil or Indonesia. However, this could be politically unfeasible for a Trump administration. Trump's America First policy could make it difficult to justify such investments, as it runs counter to his base's demands for job creation and manufacturing revival in the U.S. This is where things get tricky for the U.S. As more manufacturing shifts out of China and into BRICS countries, particularly in Asia and Latin America, U.S. industries might find themselves losing their grip on global supply chains. What's more, this change could see the rise of non-dollar transactions, further weakening the position of the U.S. dollar on the global stage. The demand for the dollar could diminish, putting U.S. Treasury bonds at risk. If Trump pushes forward with his protectionist policies in 2025, we could witness a mass exodus of manufacturing jobs from China to countries like Brazil, Indonesia, and other BRICS nations. This would directly counter U.S. economic interests and could further isolate the U.S. from its traditional allies. As if all of this weren't enough, the Taiwan issue is also looming large. During a recent speech, China reaffirmed its plans for reunification with Taiwan, emphasizing its One China policy. Beijing issued stern warnings to the West, particularly the U.S., not to meddle in the situation. This has significant geopolitical ramifications, as the status of Taiwan is central to China's long-term strategy for regional dominance. In conclusion, China's speech was not just a message to its own citizens, or to BRICS countries. It was a bold declaration to the West that the global order is changing, and China is positioning itself at the helm of these transformations. The year 2025 promises to be a volatile one, with rising trade tensions and competing global powers vying for influence. If the U.S. and China do escalate the trade war, it's sure to lead to fascinating and unpredictable outcomes. What do you think? Can China weather the storm of a full-scale tariff war, or will it alter its approach? And how will the U.S. respond to these growing global shifts? Share your thoughts in the comments below, and make sure to like and subscribe as we navigate these turbulent times.
Stay safe!